All right, fantastic. Thank you, Darrell, as always. Let me do a quick sound check here and make sure we are all buenos. Muchos buenos somos. Perfect. Okay. Well, cool. So yeah, so tonight, a little different. We're just going to kind of dive into, I wanted to spend a little bit of time just kind of looking at a little bit of some bigger picture things, some bigger picture trading ideas, and then we'll kind of bring that home for those of you just talking about what we're kind of be doing in Austin the next couple of weeks. And so the idea with this, of course, is just to kind of get kind of get a sense of where are we now, in the economic cycle, what big moves we can expect, etc. And I love this visual because a lot of times in trading, it's so easy just to get caught up in the next big thing. It's like, okay, gotta go catch that next, gotta catch the next thing. And I think that's a carrot on the end of the stick. At first glance, it looks fairly unusual, but we just want to make sure that we're kind of following a systematic, I was thinking the same thing. It's like, let's go to the next slide. What we want to look at here, though, is understand what's going on from a bigger picture. And the one thing I love about the economy is it doesn't really matter what's happening. Because I mean, 2008 was one of my best trading years. Obviously, that was a year where the markets were going down, right? So it doesn't really matter if the markets are going up or down, but it does matter if there are some big seismic shifts on the horizon, because if you're not aware of it, you can get knocked flat on your back. And as a trader, that's never fun. So we want to understand the bigger picture and understand what's going on so we can trade it and make money from it, and then not get caught by any surprises, right? Just kind of getting crash proof. We'll look at a couple of trade ideas, and then we'll talk about the mental game, and then kind of tips for taking a strategy for taking your trading to the next level. Hello from Toronto. Yeah, and for those of you guys that don't know, I got to remember to pack my jacket tonight. So in the morning, I'm going to be flying out at 9 a.m. in theory, if the storm doesn't completely shut down all air traffic, to 9 a.m. to New York. So there's that whole airplane trade thing, which I know is, you can't trade on a superstition, but it's something that's actually had an impact on the markets quite a bit, or at times, somehow times well, with big moves both up and down. And so anyway, just an FYI. So I'll spend some time at Real Vision, and then I think on Friday morning, Fox Business, so it should be fun. All right, so let's take a quick snapshot on, I'll take a quick snapshot of where we are right now. So obviously the cues are on fire, okay? Tech, semis, new all-time highs, cannot be denied, all right? Now, if we look at the S&Ps, they're doing okay. I mean, at this point, 3 times we've come up against the 786 retracement, and 3 times it's been rejected. So is the third time the charm? Are we going to be able to blow through this? Because if we can close above this on a weekly basis, then we're going to new highs. Very, 90% sure we're going to new highs. But if this gets rejected again and we close the week back in the zone, guess what? We're right back to where we started, even though you've got a super strong NASDAQ. This continues to be the most important index because it's the most balanced. If we look at XLP, all right, XLP has been in trouble. If we look at XLU, XLU has been selling off since December. Now, there's another reason that XLU is selling off, which is part of what we will be tying into this presentation here later. Yeah, the NASDAQ had a great breakout from its wedge. And then we'll actually look at, we'll look at the S&Ps here too. The key with this wedge at this point is that it's able to stay breaking out. So if we actually close back into this wedge, then it could turn into like one of the biggest bull traps on the planet. So we just want to be objective. If we're going to buy something, we're going to buy tech. I mean, that thing, it's just holding up so well. But there's a lot of other sectors out there that are experiencing negative money flow, and guess what? Those can take the S&Ps down. So the difference is if you're invested in the S&P 500 as an index, we've got to pay attention to that. If you're trading Netflix, you're trading Amazon, it doesn't matter. You're trading Netflix, you're trading Amazon, right? But we want to kind of understand some of the implications. So the first thing that we want to look at is because a lot of the talk I'm hearing right now is that the markets are, frothy. Okay. They're extended. I know at the latest, there was just a conference last week in San Diego, John Malden, who, I really like his work. I did not go to that conference, but I've talked to people that have gone, and it's like the end of the world. I mean, essentially was the theme of the conference. And I get it, everything looks toppy, there's bubbles. But from a trading perspective, we want to look at this objectively, not that something has to happen. If the really end of the world talk to me is just kind of like, give me a break. It's what's the trade, what's the move, and how do we take advantage of it? Yeah, and so Rick's a good question. Could the news tonight about the tariffs on Chinese tech be a catalyst for bearish tech? And what it comes down to, and this is something that Henry's been very, very good at over the last year and a half, is price is price. So the news is interesting, but price is price. And so we let the price tell us. If tech can shake off that news and keep on rallying, that just shows how bullish it is, right? So we just want to be, the main point here is we just want to be very, very careful about getting a bias. And so I'm going to talk a lot about some things tonight that it may sound like it's like, okay, John, do you have a bias here? But it's really trying as hard as I can to be objective and say, this is the landscape that we're looking at. These are the big moves that can happen in that landscape. So I don't care if it's up or down. I just want to know where the potential big moves are, and if there are some potential hiccups, what they look like. So the truth of the matter is that fundamentally, the economy is rocking and rolling. Consumer confidence is strong. Consumers are spending money. Jobs are being created. I got to tell you one thing, and I'm in YPO and EO, and so I see a lot of surveys of business people. And business people are just super bullish. They're willing to spend money. They have, whatever uncertainty they had is gone. It doesn't mean it's going to last, but it's interesting. Okay, so that's one side of what's going on here. Manufacturing is strong. Jobless claims are at a 45-year low. Wages are up. Unemployment has dropped to 4%. Okay. The leading index, the LEI, leading economic indicators, it keeps hitting new highs. Now, this is an older one from 2016, but since then it's gone up. The main thing with this, and this is actually a really great indicator of, oh my God, are we almost in a recession? So you can see in 2000, I remember this because I was watching this back in December, January 2000, and it started to roll over. I remember I started shorting the market here, but you can see that this wasn't quite ready yet. It kept going higher. But what happens here is that this starts to roll, and then the market falls, and then we go into recession. Okay, this started to roll in 2006, right? Way before the blah. So none of that's happening right now. So just to be clear, none of that's happening right now. And so that just means there's essentially, according to this, there is no recession looming on the horizon over the next, 12 to 24 months. So we always want to keep that in mind. We want to balance that with the doom and gloom. So what I'm noticing now is that the doom and gloom newsletters are exploding. And I'm always, conscious of that because first of all, I kind of use it as a contrary indicator, but at the same time, there's nothing worse than get married to an opinion that's dead wrong. So what we want to look at again is a balanced approach to what's going on in the market. The other thing is so far so good on the yield curve, right? So what's the yield curve? And the yield curve is a wishy-washy kind of a thing, but the main thing is, okay, so we're talking about the 2-year and the 10-year, okay? So right now, and this is approximate, the 2-year is like 1.8% and the 10-year is 2.9%, okay? That's good. You can borrow money at low rates in the short term and lend it longer term at a higher rate. That's the spread. When it gets inverted, then you would see it more like this, where the 2-year is 2.9% and the 10-year is 1.8%. When that happens, typically that is, here we are in 2000, right? Boom, recession. Here we are in 2007, recession. Again, and that's not happening right now either. So again, you want to balance out any doom and gloom with the reality of what's happening out there. So for real estate, new home sales are soaring. Okay, now one thing to keep in mind here is we're not at that brisk pace we saw in 05, 06. So, it's not, I wouldn't call the market, the housing market isn't on fire, but it's certainly, now in Austin, I know Austin prices have risen above, and I don't, every area is different, but if we look at prices, prices have risen above here, but Austin never had a bubble. So, Vegas bubble, Miami bubble, but Austin was never a bubble. So, the real estate recession in Austin wasn't so bad. Housing prices fell 20%. Builders who were over leveraged went out of business, of course. But anyway, what's interesting right now is that you can see new home sales and existing home sales continue to rise, okay, which is very bullish for the economy. Now, what the problem right now we have is what's called the Fed credibility gap, okay, and what is that? That means that the Fed has been talking hawkish, mostly under Janet Yellen, but then anytime there was a sign of turbulence, they would retreat from that hawkish talk and they would not raise rates. That's called the Fed credibility gap. I think that period is coming to an end. We'll see, but there's a huge couple of dangers for getting too aggressive on interest rates, which we want to understand. Yeah, Austin is on fire right now. I tell you what, we've been buying land out in Wimberley. And ever since they put an HEB in Wimberley, we have 1,300 acres. We don't own 1,300 acres, but there's 1,300 acres across from us. It just got sold. They're going to build that into 20-acre lots. There's another place subdividing. So we're trying to grab land and just hold on to it, just to have it. But it's just the development out there is insane. Of course, it's the same in Austin. Concerns. So the main concern for the markets right now is ironic that once you get to the point where you get stronger jobs and jumps in interest rates are all signs that inflation is getting triggered. Okay, inflation is not a word that we've heard for a while, and for a long time, when I know 3-4 years ago there was big talk of oh my God, inflation's on its way, and I would just look at the bond market and I'm like, nope, bond market's rallying. The bond market is rallying and making no highs. There ain't no inflation on the horizon. Okay, bond market is very far seen. If the bond market is really the only true crystal ball out there, and if it's rallying and making new highs, it doesn't matter what the news is. That's deflationary. Okay, it sees deflationary forces, and we'll get to bonds here in a second. So, strong economy will edge interest rates higher, okay? But if true signs of inflation heat up, then interest rates will actually rocket a lot faster to combat that, okay? And there's a couple of other things going on here too. We just want to be aware of this. Now, keep in mind that inflation right now is actually good. Interest rates right now is actually good because it's a sign that the economies of the world are picking up steam. And it's true, they are. The only economies right now that are not doing well, it's like Venezuela and I think Saudi Arabia. Everybody else is growing, okay? And that's the first time that all the world economies have been in sync, in like 12 or 13 years. So that's all good. And also keep in mind the stuff that I'm talking about is a tick up in interest rates is not going to make anything bad happen next week. Okay, we're talking a little bit of a longer term view here. Now, this creates a fully ironic situation that we're going to dive into in the markets in a little bit. Strong economy is good, right? But if it's too strong, there are some big problems that from a financial wealth management perspective, but we need to keep in mind, okay? In addition, there are red flags in utilities and transports. Utilities especially have been rolling over and has acted as a leading indicator in the past. Now, it's not a leading indicator for the economy, okay? It's a leading indicator for inflation. We'll look at it, if you look at a chart of the Utes are getting crushed, okay? They're actually falling faster than bonds. So to me, from what I've seen in the past, that is a sign that inflation is actually rearing its ugly head, and we're going to start seeing the impact of that. And what it tells me is that the rate hikes are going to have to start getting more aggressive. So the most important market in the world right now is interest rates. It is very, very likely that a multi-decade long reversal is taking place. The last time we had a reversal was in 1981, right? And that's when the 30-year peaked at around 15%. Now, in 1981, obviously I was in elementary school or whatever age I was then, but I remember my parents having a mortgage, but I remember they had an 18% mortgage. And can you even imagine an 18% mortgage right now? But then on the other hand, if you had $100,000 in savings and you had 15% interest in the bank, that was actually some real income, coming in. And so that, there's pros and cons, obviously, of high interest rates. So the bottom line here, and we're going to talk about one more thing that's going to impact bonds, but this means a huge bear market in bonds is very likely already started, and there is plenty of room to participate, okay? Bonds selling off right now are selling off on some technical signals. They're selling off on a strong economy, but what's going to happen is that sell-off will increase with signs of inflation. It'll actually also increase with a lack of buyers. And right now, China is saying, you know what, this whole trade war BS that Trump's throwing at us, I think we're just going to stop buying bonds. So you have the recipe here for bonds to crater and interest rates to spike up. Okay, and we just want to understand what that means, and from a trading perspective, what opportunities that creates, and of course, what pitfalls that could also create that we want to avoid. Yeah, TBT 401k. That's funny. That's funny, Brad. That's okay. I don't think Henry was born yet at that point. So, let's see here. So if we look at, and again, let's just look at here. I mean, you can see, here's a couple of things here. Interest rates are low, and then there's a war. Interest rates are low, there's a war. Interest rates are low, American Revolution. Interest rates are low, War of 1812. You've seen a theme here. Interest rates are low, Civil War. Interest rates are low, okay, World War One. Interest rates are low, World War II, which then kicks off a huge economic growth. Okay, so 1981 we peak out, and here we are now with interest rates lower than they were at the Great Depression. So now one argument would be, oh, we have low interest rates, so obviously it's time for another world war. I actually don't. That's not what I believe. But I do believe and look at the cycles, right? And I think it's time for interest rates to head up. So just from a technical cycle perspective, it actually makes sense. Okay, so yeah, we'll talk about gold here too. So here's the most important chart right now. So this is a monthly chart of the 30-year bonds. Massive head and shoulders top. Okay, we haven't really seen that. We've seen, in 2009, this big spike up, and a lot of people in 2010 were talking about, oh, the interest rates have bottomed, up, new highs, right? Oh, interest rates have bottomed, new highs. Remember, as long as bonds are going up, what they see on the horizon is deflation. And then now finally, and then boom. And frankly, this is to me the most surprising rally. I was surprised at that one, but again, there was a lot of things going on on the planet that were not clear. Well, now things are a lot more clear. We broke through this neckline here, and if we do a 1272 extension, that takes us to 112. You can see this big old voodoo fire line there right at 100. So I think that's something that's a very, very possible here. Now how long would it take? I would say if things start really going pretty fast, it could happen quickly. I'm not talking like weeks, but hey, this time next year. So, if you want to see this chart in Thinkorswim, the symbol is /ZB, and it makes no sense, but that's just what it is. So that's 30-year in TOS. So how that works is ZB became the electronic symbol, whereas US was the pit traded symbol. But in TradeStation, if you do at US, it actually blends the two together, and yada yada yada. All right, so I mean, essentially at this point, what we're looking at is 2020 for mortgage rates to get back to 6%. All right, that's not a huge deal, but look, if you're buying anything, if you're buying real estate, don't get an adjustable rate mortgage. You lock it in. If you're looking to refinance, lock it in. So right now, I think if you guys probably know better than me, but I think 30-year, let's actually look right now. What are 30-year mortgages? 30-year mortgage rates. let's see, lendingtree.com. Of course, I can't get any, oh my God. So I can't, you got to fill out forms, which I'm not going to do right now. Okay. Oh, perfect. Adam's in the business, 4.37%. Okay. So, perfect. So again, from what I'm seeing here, if you're thinking of buying a house, or anything like that, I'm actually to me, debt is not a bad thing. But on something like this, and if you can take on debt and lock it in and put that debt on an asset that's going to appreciate, fantastic. Because you can if you can lock in 4.5%, great. That's cheap money, and yada yada yada. Yeah, 100% down. Yeah, a tool, and that's a fantastic question. So we'll come back. Well, let's actually talk about that right now too. But so to me, 6% is actually a pretty magic number. So I would say here, and by the way, one of my favorite books of all time, if have anything to do with real estate, is a book called The Secret Life of Banking and Real Estate. So it's the most boring title ever, but it's one of the more fascinating, and it's actually a well-written book. It is by, I know the guy, and the name just escaped me. Does anybody know the name of the author? I've got it in my book, my office here. It's Philip. There it is, Philip J. Anderson. So Philip J. Anderson. So I'm bringing him up because he has timed all these cycles really, really well. And according to his models, the next major real estate top is going to be in 2008, 18, 20, 20 is 2026. So what I'm looking at here, the idea is that initially here, we're going to see mortgage rates rise, but initially, keep in mind, rising interest rates are a sign of a strong economy. In a strong economy, wages also go up. People have confidence. They'll buy houses. So initially, I'm not looking at this as crimping real estate. But at some point, there's a magic level that will start, putting downward pressure on it. And remember, back in 2000, we were at 8%, right? So another Aussie, yeah. But the book's amazing. I highly recommend it. But he's saying, according to what he's looking at and stuff like that is based more on demand, the idea of capitalizing rents and stuff like that. The next 2008-ish type bubble bursting will be 2026. So that's still a healthy amount of time away from where we are right now. Okay. So that's just to say, like, don't panic and sell your house tomorrow, right? I don't think I'm not a real estate expert, but I do look at those cycles, and it's still a good it's still a good time to kind of get in. And so what that begs the question. I got this chart from Mark Chaikin. What's happening here? So the most bullish scenario that you're ever going to see is what we saw in 2009 to 2014, where you have falling rates. Okay, and to keep this in mind, this falling rates may not be a situation we see again for 20 years. Okay, falling rates plus rising earnings. That's the most bullish scenario you're ever going to see. Okay. So from there, and then 2015, we had falling rates and falling earnings. Okay, so we had kind of a sloppy, kind of a situation there. That was kind of the unknown. That's where bonds were making new highs. Right now, we're in a situation where we have higher rates but rising earnings. Okay, so really the key here is, are earnings rising or not? Now, what we're going to get to at some point, and again, I'm not talking next week, I'm talking interest rates, when the 30-year crosses 6%, you could get higher rates and falling earnings, okay? And that's the most bearish scenario that you can get into, okay? I want to be clear that I'm not saying we're there. I just want to say that we're setting up for that situation down the line, okay? Does that make sense? And so, so we just want to be aware of that, and we want to be aware of a couple of repercussions from that. And then also, we want to see what industries do well in that environment. Nick, that's for Amazon opening up a checking account. I have no idea what bank they would choose. So I don't. Yeah, I don't know what relationships they have. If they'd want to start their own. You know, I don't even know if they can start their own. Like Walmart, do they have their own credit union or something like that? But so yeah, anything Amazon does there, I'm pretty fascinated by. Interesting. Okay. Now here's the only part that scares me, and I'm the first to admit that I don't necessarily know if this is going to happen, but it certainly seems like a JP. Okay. But here's a likely scenario. Now, part of this is okay, keep it in mind here. So again, these are all like top of out of the back of my head numbers. They're not going to be straight on accurate, but the idea is the same. So for a long time, you know, 2002, 2000, 2004, the US had about $4 trillion in debt. And with the interest rates where they were at 6 to 8%, we were paying about $385 billion a year in interest payments. And of course, that money comes from what? The taxpayer. Okay. Now we've got about $24 trillion in debt, and our interest payment is $385 billion. Why? Because interest rates have plummeted. You know, 1%, 1.5%, 2%, et cetera, et cetera. Now, we ain't going to be paying this down to $4 trillion. Okay, where's $20 trillion going to come from? Nowhere. So the main scenario here that's scary to me is that, you know, the debt here is not going down. Okay, if anything, it's going to rise. Interest rates go back up to 6 to 8%. Then what happens is, wow, we have, you know, a $1.6 trillion annual interest payment that comes from what? Taxes. So to me, that's one of the biggest things just to be aware of. So, how do the Trump tariffs? We'll actually talk about the Trump tariffs here too. All right. So this whole thing, this to me is probably the main scary thing that could happen. But this is more about, you know, wealth protection, making sure that you are setting up now tax deferred vehicles. You know, whether it's Roth IRAs, 1031 real estate exchanges, just anything like that that's tax deferred will help. And yeah, it's just looking into that seriously. It's not my area of expertise, you know, certainly an area that I'm looking into more of. But that's the one scenario that kind of scares me in terms of, you know, what. So in 2022, what's going to be going on? Oh, we're just going to be taxed into oblivion. Exactly, and it could be tax on net worth. Like so, again, not my area of expertise. I just know that if the interest payment goes from $385 billion a year to $1.6 trillion a year, the money's going to have to come from somewhere. And Trump ain't going to pay for it, nor is the next politician that's there out of their own pocket. So how do you keep long-term from clouding short-term? Okay, so that's a good question. So the problem, what'll happen is you'll hear something like this. You know, I call it the Stansberry effect. And you'll read something and say, oh my God, you know, in 10 years, the world's going to fall apart. And that can cloud what's happening today. I want to be clear that today things are fine. It's just more understanding what could happen, right? So, and you know, and this is a theme I'm going to talk more about. And obviously, you know, I'll, you know, research it more in terms of like, wow, if this does happen, you know, one of the best things you could do is do X, X, and X. At this point, it's just more just kind of being aware. I mean, the good news is, again, we're not going to wake up tomorrow and it's like, oh my God. But we want to, you know, understand these cycles and what's going on. You know, Keith, very possible. Very possible. So, you know, and let me make some notes on this because this is actually, this is a topic that I'm intrigued by. So what happens when we have 2 trillion in annual interest payments? How do we protect our wealth? I've got 3 people I can ask that question to and get some answers, and I'll, you know, come back to you guys and share at least what I find. All right. And again, please, 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 I know when you hear something like this, it's easy to start panicking and stuff like that too. And I am not panicked at all. I'm not looking for anything here in the near term. Today is 2018. I just like to start thinking about, okay, what's going to be happening in 2025, right? Now, is that going to impact the 78-minute squeeze on Netflix tomorrow? No, right? So, because when you suddenly realize all this is happening, then it's too late, right? So that's the idea. John at 60 years old, young, at old, you may be intrigued, but I am scared shitless. Fair enough, but again, I would just say that. So here, okay, here's a story. So Warren Buffett, his father, this was back in the 1950s or whatever, but his father was paranoid, like economy is going to shit. We're putting all our money in gold. We're burying it in the backyard. And that was his mindset. And so he missed out on decades of growth, right? And I think the main thing to realize is that when you see a situation like that, there's always something that you can do that's positive, but you have to be aware of the situation and look it straight in the eye. So if that makes sense. So this is something like, look, this kind of stuff, I'm fascinated by history and the economics of history. And there's always ways to kind of look at things with foresight and plan and not panic and stuff like that too. So don't carry the weight of these implications into, like, trading into next week, right? This is just something like, wow, 5-8 years from now, the landscape's going to be pretty different. What are some steps that I need to do today, to kind of take care of that? So, okay. So let's keep looking here. So bonds and dollars. So China is a huge buyer of U.S. bonds over the years, which has been a huge buyer of U.S. bonds over the years, is saying it will start to slow down purchases or even stop them due to trade war tensions. Okay, this is kind of gets back into the whole tariff thing. And that's another piece of the puzzle that could cause bonds to drop even faster. So remember, bonds are rolling over now because there's economic activity is positive, so we're seeing a slight increase in rates. If and when we start seeing serious signs of inflation, they're going to drop even faster. And then if you have China, one of the biggest buyers of U.S. bonds, stop buying, even so, just keep in mind that you definitely have some activity there. So the biggest short-term impact will be mortgage rates. Again, if you're thinking of refinancing, do it now. Now, here's the interesting point, and I kind of think that the Fed is going to have to call BS on themselves. So they're talking hawkish, right? And they're right. They should be talking hawkish. The economy is heating up, but there's two big problems with that, right? One big problem we already talked about: 24 trillion in debt. They cannot afford to have interest rates go up too much. Okay, so that's a big problem. Now, to an extent, it's in their control to an extent and out of their control to an extent. If one scenario that I see is that they say, you know what, we cannot, if we raise rates, if we have to raise taxes due to rising rates to pay off our interest bill, essentially our country could revolt, right? I mean, I think there'd be a lot of pissed off people. So then their option is to go full bore quantitative easing, and then we potentially see negative rates. Okay, that's a possibility. I've talked to economists that professional economists that see that as a possibility, and again, I don't see it right now. That's too long, too far. All I do is look at the charts that are in front of me, and the 30-year bond is that chart. But so keep in mind, they've got to manage that. But conflicting with that is they want a weak dollar. Okay, so if interest rates start skyrocketing, that's obviously going to boost the dollar. So right now we're in a situation where the U.S. dollar is at kind of like the perfect spot. It's trading around 90. The Trump administration has even pretty much fully said that weaker dollar is good. It's good for business. It's good for global companies. It's good for emerging economies. Okay, because all their debt's in dollars. So when the dollar rises, that's like a adjustable rate mortgage on their debt. But right now, so they want to keep the U.S. dollar weak to help U.S. trade. Right now, the U.S. trade deficit is 4% of GDP. All right, and the rule of thumb is that any country with a trade deficit of more than 2.5% of GDP is set for a major currency sell-off. Okay, so what they're trying to do is actually have a weak dollar to get the trade deficit lower so it doesn't actually implode the dollar. All right, big hairy stuff going on out there. And again, this is not going to impact us if we're going to do a 78-minute squeeze on Netflix, right? So here's the dollar chart. Keep in mind that in the go-go days of 1999, 98, this thing was trading, if you can imagine it, around 120. I forgot exactly when the euro came out, but I think around this time we still had Deutschmarks and things like that. But at one point, you know, whenever the euro came out, it was traded at like 90 cents. 99, okay, yeah. So here it was fun. Like when you go to Europe, you'd have Deutschmarks and Guilders and all this kind of fun stuff. And then in 99, we had the euro. So this huge rally that we've seen in the dollar has really only been a move to the 618 extension. All right, so now, you know, is this thing ready to resume to the downside? Very possible. Yeah, I like that, Scott. Oil price and oil is the new US dollar. All right, so back to inflation. So a weaker dollar makes US exports less expensive and imports more expensive, which is positive for US business, the stock market, and the economy, and it would reduce the trade deficit, which would also fuel inflation, which would fuel interest rates. So here again is their quandary. They do want to reduce the trade deficit, but that also fuels inflation, okay? So it really just comes down to inflation, which is why I think shorting the bonds is one of the best trades on the planet right now, i.e. buying longer-term puts in TLT, or, you know, there's the reverse one as well. So anyway, it's a perfect storm for high interest rates in the year ahead. What's going to be interesting to me is that, you know, when anytime that they've backed off from raising rates, it's always been more economic concerns. Oh my God, the economy is flagellating here. Let's not raise rates and, you know, continue to add liquidity to the market. Versus, oh my God, the economy is so strong, you're supposed to raise rates to cool it off, but can they really afford to do that? I mean, they're in a quandary. So I'm just like fascinated, like how are they going to get out of this? TBT, yes. So impact and opportunities with rising rates. So keep it in mind because we haven't seen rising rates for a while. Rising rates increase the cost of borrowing, which reduces investment, which leads to lower economic growth. Higher mortgage payments reduce consumption. Okay, so think of it this way. When, you know, if mortgage rates go up, you know, the average consumer, you know, if mortgage rates go up $150 a month, then that's money that's not going to restaurants, going to Disney World, going to Starbucks. Okay, that's essentially how that works. Also, higher mortgage interest payments at some point, not initially, lead to a fall in housing prices. Increased return to savings, of course, then that if you're saving money, it's like, okay, that you're reducing consumption. And eventually it leads to lower inflation. So that's it, just so if you weren't aware of that. And again, the effect of an increase on interest rates, the one that scares me is this one. Government will see rising borrowing costs. Okay, at some point that comes back to on us. Yeah, and Sarsi, and if I pronounce your name wrong, and you have a great point there. And we got to remember that there is a ton of investment coming into the US as well, for sure. So believe it or not, I'm actually super bullish on the economy. And it sounds like it's like, oh my God, this is, you know, it's, oh my God, this is freaking me out. We just want to be aware of what's happening and be positioned for it, right? All right, so industries that do well, I think probably the most obvious one is financials. So, you know, JP Morgan and TD Ameritrade, they're going to do just fine in an environment like this. Consumer discretionary stocks, because remember, if interest rates are going up, that means the economy is heating up, wages are rising. So kitchen appliances, cars, clothes, hotels, restaurants, movies, okay? So again, remember initially, any industrials that benefit from an increase in housing starts, okay? Small caps. Remember, small cap companies typically are only doing business domestically, not internationally, and the domestic economy is strong and they're not worrying about any currency devaluations or anything like that. So those are industries that I like based on this macro idea. And then of course, just buying puts on TLT or calls on TBT, which of course is an inverse. And then the big question here, I think, is going to be tax deferred vehicles, like from Roth 1031 exchanges. Which of those would be good to be in? Which one of those would be in danger of being taxed? And that's just an area that I'm going to be looking into more. And of course, I'll share with you at least what I find. What about cryptocurrencies in an interest rate environment? So it's a good question. I think cryptocurrencies are their own planet. So, I think that's something that's going to be much more supply and demand driven, especially over the next year or two. So Japan has borrowed a large amount, but the interest rates are very low or negative. Can you please comment? Sure. So the reason Japanese interest rates are low, and let me see if I can find, but it's their economy. So now this, again, I'm not an economics professor, but here's the difference. This is actually a good quick history lesson. And again, this is going to be and I apologize to anybody who has a better grasp of this than I do. So this is going to be very rudimentary. So we have Japan, 1980s bust, and then the USA 2008 bust. So real estate bubble burst, and Japan waited 4 years to start doing quantitative easing. Okay, USA bubble burst. I think they waited. I think it was immediately. Let's call it 1 month. Okay, to do QE. So the U.S. learned from Japan and attacked it immediately. Okay, so that's the first difference. Because they waited 4 years, the deflationary drag grabbed hold and would not let go. And I think, and I don't know if they're just finally coming out of it, but they haven't had any economic growth is the problem. And so they've gone to negative interest rates and things like that just because it's just no growth. Does that make sense? So that's a real short version. The U.S. attacked this head on, and so we actually started seeing growth, some growth. A couple years later, we can obviously see 2018, 10 years later, there's a lot of growth, whereas 20 years later here, it was actually still deflationary. So again, that's a really short, rudimentary version, but essentially the answer is aggressive QE. Fast, aggressive QE is quantitative easing was the difference. Yes, Dr. Bruce, exactly. Extreme betting for higher interest rates. Okay, so we got that. Industries that do poorly. So another short here is utilities, and they're already falling. But remember when this whole interest rate thing started, they were trading at $17. So I think XLE could actually go back to that level, believe it or not. So utilities are a short. Telecoms could essentially be a short. Because they're pretty much bond substitutes. Utilities actually move faster to the downside initially. Not all real estate investment trusts, but many of them are structured for yield and treated like bonds. And then global industry and energy companies. These, they have high yields right now due to more depressed stock prices, not increased cash flow, and rising rates are going to hurt their cash flow even more. Yes, XLU. Thank you. Yeah, when I'm talking about utilities. And then this is a current snapshot, and of course this is from Chaikin Analytics for those of you that are familiar with this. Financials and technology right now are the two most bullish sectors. Okay, and I think if you're going to go be long something, just focus on financials and technology. Plenty of very good action there. And remember, rising interest rates are obviously good for financials, but rising interest rates are also a sign of an economy that's heating up, which is good for tech. The bigger problem here with the broad-based, indices is all of this. And you've got some like, again, utilities, real estate, consumer staples, consumer discretionary, which are right now outright bearish. These right now are kind of interesting. I think that's actually more a reflection of money flow coming out and going into these sectors versus the economy, because the economy is showing that consumer spending is strong. But just something to keep in mind. Okay, so trading goals. Now, hopefully that helps in kind of understanding the big picture. This is something that I'm going to continue to update because it fascinates me. And again, I can't emphasize this enough. When you look at something like that in terms of a big picture, sometimes it can be scary, but don't, you kind of just need to, there's always that fear of the unknown kind of a thing. And just look at it as kind of the risk of the unknown. Okay. So if this happens, what can we do? From a trading perspective, there's plenty of opportunities there. And we just want to, eyes wide open kind of a thing. So, like anything in something like this, we always want to start with the risk, and the rest starts to take care of itself. Okay, if we focus on the reward, then that's the kind of stuff that can happen. Oh my God, how much? I'm going to put my whole portfolio short bonds. Well, that's focusing on the reward, right? We want to embrace the market environment. Okay, the art of trading does go beyond, hey, what's the setup? It's also understanding the nature of the overall market and the concept of how it typically works, right? That's the foundation, and that's where you build a trading plan. And if you're scared about all this, the key is you got to build up confidence, okay? And so how does confidence happen? Well, nothing happens without a commitment. First, it feels scary to take the next step, okay? Of course, that's called courage. But then after that, you start to build competence, and that's where confidence comes from. So it all starts with a commitment. Also, we want to know as human beings that we are all wired to defend our choices to the death. So if you do read something, and I got to pick on Stansberry because they write the copy that scares the most people on the planet, is that we don't want to get too married to that idea, because once we get married to it and we make a decision on it, we actually unconsciously will defend that. And we just got to be really careful about that. It's just something that humans are wired to do. So you just got to be very, just look at it as neutrally as possible and just focus on the risk. And having that flexibility to change your mind if it's not working. And the easiest way to change your mind in a trade is just look at it and say, is it working or not working? So the reality of it is that the markets are a mix of, at the one end, it's the spectrum of large amounts of money moving in and out of asset classes, all right? And that's the kind of thing that we're seeing in the bond market right now. Large amounts of money starting to move out of bonds, okay? It's a bear market in bonds. At the other end of the spectrum, there's a mob mentality and all of the emotional and psychological traits associated with large groups of human beings piling into wrong assumptions, okay? Kind of dumb money. And then in between though, that you've got high frequency traders and the algos, they're kind of taking their 2 pounds of flesh along the way. So our place in this mix as retail traders is, I think, very enviable. We're trading negligible size. So yeah, the algos will pick us off for, a couple, a little bit here and there, but they're trading on typically a much shorter time frame. So we have the advantage of liquidity. We can trade instruments that aren't necessarily super liquid, so the funds stay out of them, which is great. We can typically get in and out of positions with the push of a button, whereas large funds may take weeks and even months to unwind large positions. At the end of the day, because of our flexibility, we have the opportunity to make exponential gains. And really our biggest danger is ourselves, thinking that one day we will know it all when it comes to the markets. And I love this quote from Michelangelo. When we were traveling over the summer in Europe, I read a biography of him. It was great. The guy was, feisty guy, but even in his 80s, it was every day he was always like, I'm still learning. So the key with all this is to understand the game and then work continually to put the odds in your favor. And I love this, the human brain versus trading. Character tests are the daily reality of a trader. It's possible to be heroic if you're sitting alone in your office, even if it doesn't make a good movie, okay? And I love this quote, what's holding you back is the thought that something is holding you back. So it's just kind of getting in sync with all that stuff. All right, so I see some questions here. So I just want to show you guys, so we're gonna be doing, and I'm happy to answer questions too about inflation and stuff like that. I want to tell you guys about this real quick because we're just now opening up this to a live stream. So we are doing a live event in Austin, March 25th, 26th, 27th. It's a mentoring type environment. And we're now opening it up for a live stream. For the folks that are going to be there, a couple of special guests. I think you guys know most of us. Myself, Henry, Bruce, David, Fib Queen, Raghee, Eric, Danielle, Jared are all going to be there. And we're going to have 3 special guests. Mark Chaikin, whom you guys know. I think a lot of you guys know. So he'll have some great insights. RJ Johnson, former kind of algo guy. He's going to come in and just tell you how the algos are ripping you off and what to do about it. And then Seth coaches professional athletes in mental toughness, and he's going to come in and talk to us for a couple hours about mental toughness. And so I think it's going to be a really well-rounded kind of a presentation. Yeah, no, RJ, it's going to be great. I'm looking forward to your talk. I got your email too, and yeah, I will get caught. We can get caught up. On this website, there's a schedule of events. I won't review it all here, but you can see Sunday, Monday, Tuesday. We're going to have for those of you that are there live, we're doing a Texas Hold'em tournament, which is great. And so here's all the things. And again, whether you're dialing in online or you're going to be there live, so these are things that we're going to be covering. So a crash-proof trader strategy, okay, going through all the different setups and things like that to look at in the markets. A global macro market discussion. Live trading sessions, all right, those will be fun. Crypto contrarian, so we're going to be talking deep into cryptos there. Talking about Fibonacci's with Fib Queen, futures leverage with David, and really it's just kind of tying all the stuff in that we've talked about. You know, here's the macro picture, and then here's some strategies to kind of take advantage of that, plus any other setups that are coming up. Voodoo lines, using Elliott wave and voodoo lines together, which is, I mean, David's just been very, very consistent with this. Looking for income, different strategies that Bruce will talk about in terms of what's working now, and then really the whole mental trading toughness, which I think is critical. Without that, this is very difficult. So if you haven't been to one of these events, they're just really great. We all get to hang out, and what happens in a situation when you're doing something like this for 3 days, then and whether you're doing it online or live, you're focusing on something for 3 days, and just the fact that you're focusing on something and really not much else, your ability to gain new insights just explodes, because you're really spending a lot of time with something, and it's just like, you know, these conclusions that you make and start jumping to, it's like, oh my gosh, why didn't I think about that before? Well, it happens because of just being in an environment like this. The Texas Hold'em tournament is always fun. It's good, you know, it's good money management. Good money management techniques and things like that too. And I think we've done this 3 or 4 years, and 2 years we've had simpler people win, and 2 years we've had clients win. So this year is going to be great, like who wins, right? And it's a lot of fun. And then of course, you know, doing live trading. The room is great. You know, it's designed for traders. It's classroom style seating. So it's, you know, raised seating like that. Everybody has their own power outlet and hardwire and stuff like that too. And that was us from last year, and it was really cool. So, you know, the thing about mentoring, you know, why do a mentorship? So it's insights, blind spots, strengths, disciplines, and potential is really what it comes down to. And that's always where I've made my biggest leaps. So for insights I didn't know, okay, when in a mentoring type situation, we are passed along information or perspectives we need to hear. Blind spots I couldn't see. With an objective group and a safe group, attitudes and behaviors can be pointed out in a safe setting, which, if left uncorrected, can cause enormous harm. It's like a support group. Strengths I hadn't developed. Positive feedback from other traders can breathe life into our own motivation, especially if we've been feeling frustrated. Disciplines I couldn't build. We don't know what we don't know. So, and this is a situation where you let others who have been there before show us the way. And then finally, potential I never understood. Mentors see potential that we can't see in ourselves, which is great. And so, you know, the mentors can be there to say, look, I know it sucks right now, but if you keep this up in a couple of years, this is what's going to happen, because they've been down that road before, right? And so that's great. So again, the in-person event, I believe, is either sold out or almost sold out. If you're interested in that, it's $49.97. Again, live event. You can call. But the main thing here is that we're just, you know, I wanted to let you guys know we're opening it up to a live stream. So if you wanted to, you know, save money, you don't have to travel. You can do it from the comfort of your own home. And this way you're essentially participating with us in this event from the comfort of your own home. We'll answer your questions. You know, you're not going to be, we actually sit there and go through the questions and go through what you have online as well. So that's what that is. And so I'm happy to stay here also and answer some more questions about the bigger picture and all that. But it's the link here is if you go to simplertrading.com/live stream, that'll take you to this page. And if you have any questions, you can certainly call us here. Okay, so, and we'll get you guys a copy of this presentation as well. Are there any markets that may lead the SPX, like the bonds, volatility products, RUT, any ETFs? Well, that's a good question. I mean, so the SPX obviously is a huge, conglomerate of stuff. If you're looking at it intraday, VIX moves first, then the S&Ps. Okay. Transports are actually a good leading indicator, for the weeks. So what'll happen is like the transports will sell off for a couple of weeks, then the S&P 500 will top. That's actually very common. So I'm watching the transports right now because if they can't get their act together and break through that 618 retracement to the upside, that's not a good sign for the S&Ps, even though the S&Ps will lag the transports, right? So again, don't get me wrong, tech right now and financials in fuego, okay, they're on fire. But this reminds me a lot, in like 1999, 2000, there were some amazing rallies in some sectors while other sectors were selling off. That's fine. The main thing we want to realize is that we're not just buying the spiders and hoping everything's going to be fine. We really got to dial into where to put our long cash. Where will Netflix and Amazon be short term, like end of this week? So a lot of that really at this point is going to depend more on options expiration, right? We're kind of, I think we've had kind of the burst here. I am looking for a little bit of consolidation into the rest of this week. And keep in mind, I am hopping on an airplane tomorrow morning. Like that's a real thing. So sometimes we've actually seen a lot of volatility, both up and down for whenever I travel. It's just a weird thing. So something to be aware of. Very good. Where do you see big companies like Amazon going in the next year with the crazy growth they've had? Can they keep it going? Yeah, and so Amazon to me is a fascinating company just because, I mean, I know how much I use Amazon and how convenient they are, and it's just something that how do you compete with Amazon? Is the question, and I think the answer is you can't. And the market recognizes that. So, where is Amazon 5 years from today? Are they going to be more dominant or less dominant? They're going to be more dominant. So, the move that Amazon has had, of course, at some point, it's going to take a break. I would have a hard time loading the boat on it right here for a long-term trade, but I have no problem if there's like a 30-minute squeeze to the long side, hopping on it, right? So, I think on something like that, you got to be really careful and avoid the, oh, this can't go up anymore syndrome. And it's just taking the setup, right? So I think the one thing we have to keep in mind too is that when a company gets a market cap that big, and I don't know exactly what their market cap is it, $650 billion, $700 billion, suddenly the upside does start to get limited. So we haven't had a $1 trillion company before. Apple will probably be the first one. So, I love Amazon. I think it's a great short-term trading stock. If I was going to buy something and hold it for a year, though, I'd be looking at a stock that's got a market cap of, it's an IBD 50 stock with a market cap of, less than $10 billion. Do you think we should expect the markets to react to tweets about and domestic political news becoming the norm? Yes. The Trump tweet is a real thing. I know funds that actually monitor his stuff specifically for trade ideas. I've had brokers also confirm that when Trump talks about a stock, the explosion in activity on that stock, they can see it on their platform. Would now be a good time to short the overall market? So I don't have a short signal. So I'm always like, hey, if I'm going to short something, I need a short signal. I think there are some things to be aware of, in transports and things like that. But if somebody said, all right, you got to short something right now, I'd be shorting like, utilities, like they're dead. I'd be shorting TLT, the bond market, they're dead. So gold is interesting. So gold, gold is looking at, it's balancing itself against a couple different things. One, if we have rising rates and that creates a strong dollar, that can keep downward pressure on gold. But if inflation gets away from that and inflation actually outpaces interest rates, that's when gold goes higher. So I've always been a fan of physical gold, and you know, there on a monthly chart of gold, to me, it's got a very bullish technical outlook. So gold is something that for me, if I'm going to be, you know, trading, buying bullion, it's one of those, I'm not looking for gold to go to 5,000 by any stretch. I think it just kind of, you know, it's going to kind of hang out. But the idea of going, I like taking cash out of trading accounts and putting it into something that I can't spend easily. So it's like, okay, put it into gold, put it into land, invest in other businesses, because then all of a sudden it's because if there's money sitting in the bank account, it's like, oh yeah, maybe I'll go, you know, yeah, we should buy this and this and this. It just kind of, it's like, you know, the idea of burning a hole in your pocket. So I'm a big believer in doing things to make it get harder access to cash. And so to me, that gold fits that as well. Should I be worried about my 401k? Well, it depends what your 401k is invested in, Mark. If you're long bonds, I would be worried. But, you know, again, whatever's going on in the market, hopefully in a 401k, you should be able to take advantage of, you know, some kind of a fund that benefits from that. So it just kind of depends on I don't know what kind of choices you have. Is the short vol trade over? I think after this blow up, and I can't tell you how many accounts actually went negative when SVXY blew up. I can't imagine that that's going to be a very attractive trade again. A lot of dreams ruined with that trade. Did he, Jim? Prector put out a crash alert to have to close? Okay, well, we're obviously going to be rallying a little bit longer then. ITB, that's iShares U.S. Home Construction ETF. Well, right now, home starts are strong. So, I mean, I'm assuming that's not a yield play. So if it's home builders, how low can TLT go? So I'm looking for bonds to go from 144 to 100. And again, not tomorrow. So for TLT, I mean, that's a fairly sizable equivalent move. Any hope for GE? Boy, I wouldn't touch that with a 10-foot pole. I mean, I think and that's going to have a problem if the dollar starts to rise too. Now, I mean, it's a yield stock essentially at this point. Is Tesla rebound real? So Tesla, I think Tesla is going to see new all-time highs just because of the short interest. So it's one of those where does the fundamental story, the market cap make sense? No, but you know, are there a lot of people, too many people betting it's going to go down? Yes. XLF, XLK. So those are the two sectors that I would focus in on the long side for sure. Any thoughts on Boeing and tariffs? Well, I think that from at least what I've seen with Trump is that it sounds like he's a deal maker. So his threat of tariffs is a negotiating ploy. He's already, coming down and saying, okay, well, for NAFTA, we're not going to do tariffs if they cut a deal. So, we'll see. Obviously he doesn't call me for advice, but from what I've seen, he likes to, throw things out there and then use that as a negotiating tool. Yeah, BKNG looks great. How far to go out for TLT puts? So I generally don't like to buy leaps, but I would buy leaps on TLT puts. So, going out to April, May 2019 and buying some puts. And it's great because the implied volatility on it's low, so the options aren't that crazy. Would you go short on the bonds through the futures? So sure, absolutely. If you have experience with futures, futures can be hairy, right? Because it's like, oh man, you got a 2 or 3 point move against you in bonds. That's like $2,000 or $3,000 a contract. And you could also use options on bonds. So, but yeah, I'm fine with it as long as you position size correctly. Yes, Frank, I can see your questions. Where do you see XLF, XLK by June? So XLF, I think, will actually outperform XLK if we're looking into June. XLK, I think, will continue to be fine. And then the question is just that, really more if the transports and things like that roll. Why don't I like leaps? Well, most of the stocks I trade, like Netflix, if you go a year out and try to buy options, it's insanity. Just the pricing of the options is crazy. But I like leaps on ETFs. The lower implied volatility and essentially the lower prices makes it more manageable. When the market cap on Apple hits $1 trillion, will that have been bullish for stocks? I think it'll be a good milestone, but again, if it gets to $1 trillion market cap, where does it go from there? Why do you concentrate on the 30-year versus the 10-year? Oh, definitely both. I definitely look at both. The 10-year is actually more important. The 30-year, I just kind of, it's more, it's a more volatile bond market, so I like watching it. Would you do a synthetic short on TLT? Anything bearish on TLT, I like. Do you think the market will remain choppy for the rest of the year? No, I actually think it's going to be fairly volatile. What about rebalance of the buyback stocks on Friday? So it's always interesting, especially like in the last 10 minutes, that causes some pukage. So if they're gonna, reduce exposure to Apple, Apple could drop $3 or $4 in a minute, that kind of stuff. So that's not my area of expertise. I've mostly more just kind of watched it, going like, wow, look at those big moves. But then after it's done, it's back to business as normal. Anything you'd like to do an elephant trade on right now? Puts on TLT. That's to me my favorite elephant trade right now. All right. All right, guys. Well, it is a little after 8 o'clock Central. I need to go home and pack for an early flight to New York City. My apologies if my flight causes too much volatility tomorrow. Obviously, if there's anything that needs to be updated, I will type that in. Otherwise, would love for you to join us here in Austin in person if you're able to. If not, the live stream. Just go to simplertrading.com. Just type that in /live stream. You can also call us. It's going to be a great event. We're going to cover a lot of cool stuff and kind of get everybody rocking and rolling for the rest of the year. All right. Okay, cool. Grab the hot dog. Great, guys. You guys have a fantastic evening, and see you on the other side.